Imagine signing one piece of paper because you were told you have to, then discovering that signature helped light a fuse under your household finances. Then imagine the numbers that show up afterwards. Your joint tax return reported roughly $116,000 of tax due. Then the Internal Revenue Service came back and said there was another $121,000 of tax on top of that, plus another $24,000 more in penalties. And by the end of this case, the tax court granted full relief to the requesting spouse for that added deficiency in penalty, meaning for her, the court effectively turned that extra $145,000 into about zero of responsibility. That's not a paperwork story, that's a control story. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this type of narrative breakdown of court opinions, please like this video and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. And yes, sometimes the tax law part is really a story about what was happening inside someone's life when the return got signed. In this video, we cover the tax court decision in the case of Asia Zaheen and Kamran Ehsan versus Commissioner of Internal Revenue, decided on January 22, 2026. The case opens with a married couple living in Massachusetts. The opinion describes the marriage as starting fast. They married on February 1st, 1998, one day after they met, and then moving to the United States from Pakistan just days later, on February 10th, 1998. They had 4 children. They lived together in the family home until the petitioner filed for divorce on September 27, 2021. And even by the time of trial, the divorce was still pending. During the year at the center of this case, 2019, the petitioner was self-employed as a physician at a medical practice the opinion calls Zaheen Medical Center, which at the time was jointly owned by the spouses. The other spouse, described as an electrical engineer, did engineering work on contract basis. Later, in the divorce proceedings, she became the sole owner of the practice. The opinion notes that at trial she estimated she earned more than approximately $300,000 per year from that practice. So this isn't a story where the requesting spouse had no income or no sophistication. The court is very clear. She was well educated and worked as a physician. But the court is also clear about something else. Who controlled the money, who opened the mail, and what happened when she tried to ask questions. Zaheen Medical Center was established in 2018, and the property was purchased in 2017. The property was titled solely in her name, and the opinion gives a specific reason. The other spouse was out of the country when the transaction closed, and seeing divorce on the horizon, she insisted it to be in her name. They used funds from a home equity line of credit with Citizen Bank to buy the property and to buy medical equipment and supplies. By January 19, 2019, they owed about $292,000 on that line of credit. Now the opinion starts painting the controlling finances picture in blunt strokes. It says she generally felt discouraged from asking about finances. It says the other spouse controlled the family's finances and opened the household's mail. It says he generally rebuffed her attempts to participate, and when spending happened on cards or accounts he could access, he sharply scrutinized and criticized her and the children. She could access only one account where her salary was paid, and the court finds she felt afraid to move funds out of joint accounts. Then it spills into the business side. The opinion says that despite having lack of medical education, the other spouse claimed to be a partial owner and the chief executive officer of the medical center. The court describes that he had full control over the practice's bank accounts and viewed the physician spouse as an employee, paying her a salary. So even when the money was generated by her medical work, the opinion says she didn't enjoy typical benefits of the ownership in 2019. When she tried to use business funds outside, things like employee bonuses and charitable givings, the court says he would become aggressive. And then the opinion drops a line that sounds less like a financial disagreement and more like a worldview. She testified, he said she was his property, that he was entitled to her earnings, and that all her property was his. And when she asked him not to use funds from her retirement account for his business ventures, the opinion says he would often communicate threats against her and the children tied to financial demands, including demands that she sign documents. He even threatened he would leave her financially ruined if she ever tried to divorce him. That's the money. Then the court turns to abuse, and it's not subtle. The opinion says that since 1998 and through the years in issue, the other spouse subjected her to various forms of abuse. It describes him breaking plates and glasses in front of the children. It describes a specific incident the children witnessed where he berated her and strangled her for eating chocolate. It describes years where she slept separately out of fear of sexual abuse, and a moment where he degraded her to his where he dragged her to his room, locked the door, and threatened to harm the children if she didn't have intercourse. The opinion also describes violence directed at the oldest son, including an incident in 2018 where he pressed a knee against his son's neck while screaming, and another incident around 2020 involving a broken piece of wood and a threat to stab before she intervened. Then the story hits the turning point. September 14, 2021. She approached him to tell him she was filing for divorce and to ask for business files and records. While she was searching, the opinion says he became violent, made threats, pushed her away, and snatched the documents. She called police. Police found probable cause for assault and battery, and on August 23, 2022, the other spouse entered a conditional tender of plea or admission, admitting to facts sufficient for a finding of guilty, and the case was continued without finding. The next day after the incident, September 15, 2021, she got an abuse prevention order, and the Massachusetts Department of Child and Family Services investigated, ultimately concluding on October 21, 2021, that the two youngest children had witnessed years of significant and ongoing domestic violence. All of that is the backdrop. Now, here's the tax spark. In 2017, they established something called KME Investment Trust, and it held a solo section 401k retirement plan. The opinion says the other spouse signed the trust documents on behalf of an entity named in the opinion, and the physician spouse signed after he represented that doing so would save them money on taxes, but she was otherwise unaware of his intentions. Both were trustees, and each had independent authority to act on behalf of the trust. Then comes the retirement money. The opinion says they used funds in her Section 401k retirement account at Merrill Lynch to pay down the home equity line of credit to avoid more interest. He represented that he would replace the withdrawn funds within 30 days using proceeds from other business and property sale. On January 14, 2019, a withdrawal of about $258,000 was made by check from her Merrill Lynch account, and those funds were deposited into the trust. The opinion is explicit that rollover to the trust was not a taxable transaction. But then, right after that untaxed rollover, the opinion says nearly all the money transferred into the trust was used to pay down the line of credit between January 25th and January 31st of 2019. A total of about $257,000 was withdrawn in 3 transactions from the trust and sent to the line of credit. Then another 1,000, the opinion states, and another 700 went to a separate unrelated account. The opinion says that parties did not dispute that the series of withdrawals totaling about $258,000 were taxable transactions. And now the human part matters, because the opinion describes what happened when she tried to verify that the retirement funds had been replaced. in February 2019, she asked for the password to her Merrill Lynch account so she could confirm the funds were transferred. The opinion says he refused and replied she needed to trust and believe her husband, believing the funds had been replaced, and critically unwilling to risk provoking his anger at her or her children, she didn't inquire further about the account balance. Fast forward to the tax return. They filed a joint Form 1040 for year 2019, reporting a tax liability of approximately $116,000, but the return did not report the second series of taxable withdrawals from the trust. She first learned in December 2021 that the retirement funds were not timely replaced when she received the IRS letter identifying unreported income. Then, on February 28, 2022, the IRS issued a notice of deficiency determining a deficiency of approximately $121,000 and an accuracy-related penalty of $24,000 tied to the unreported retirement distribution. There's also a twist in the opinion. The notice of deficiency initially treated $258,000 withdrawal from Merrill Lynch as the unreported distribution. Later, after the petition was filed, the parties' discussions revealed that they stipulated that the rollover itself was qualified and not taxable, and instead the subsequent withdrawals from the trust totaling $258,000 were the taxable event. So the tax court is looking at a situation where the money came from the requesting spouse's retirement account, but the story says the other spouse controlled the finances, controlled the mail, controlled access, and used intimidation and abuse to shut down questions. The requesting spouse asked the court for innocent spouse relief under Section 6015. She conceded she didn't qualify under two subsections 6015B or C, so everything came down to equitable relief under Section 6015F. The IRS itself considered she was entitled to equitable relief, but the other spouse intervened and opposed it, so the court had to decide anyway. Before the court even gets into the relief factor, it tells you how it saw the witnesses. It says credibility is part of the job, calling the process the daily grist of judicial life. Then it gives it bottom line. It generally found the requesting spouse, the children, and the housekeeper credible, and found most of the intervenor's testimony lacking in credibility, sincerity, and candor. The tone matters because equitable relief cases often turn on who the judge believes. Now the legal framework is detailed in the opinion, but the story version is this. Section 6015F asks whether under the facts and circumstances it would be equitable to hold the requesting spouse responsible for the deficiency and related penalty. The court uses guidance in a revenue procedure and walks through factors like marital status, hardship, knowledge, legal obligation, significant benefit, later compliance, and health. No single factor decides it. The big battlefield here is knowledge. Did she know, or should she have known, about the taxable trust withdrawal that weren't reported? On actual knowledge, the court draws a careful distinction. The income that created the understatement was the second series of transfers from the trust to pay down the line of credit. Again, about $258,000, not the initial rollover from Merrill Lynch. The court says she had actual knowledge of the initial withdrawal from Merrill Lynch, but it credits her testimony that she was essentially unaware of the trust's nature and signed the papers only because she said it would save taxes, and that he represented the funds would be returned quickly to avoid tax and penalties. The court holds she didn't have actual knowledge of the withdrawals from the trust. Then comes reason to know. And here's the court does something that feels at first like trouble for her. It finds she had reason to know. The opinion points out she was well educated, worked as a physician, signed the joint return without reviewing it, and so it didn't satisfy duty of inquiry. It says a reasonable person would have been alerted to issues by his secrecy and defensiveness about her retirement account. So if you stop the analysis here, you'd think relief might be denied. But the court doesn't stop here, because equitable relief has a concept that changes everything. In cases like this, abuse and financial control can negate knowledge. The opinion explains that abuse comes in many forms, including efforts to control, isolate, humiliate, and intimidate, or to undermine the spouse's ability to reason independently and do what the tax law requires. And it insists on specificity, not generalized claims. And then it says the requesting spouse met that standard. She testified with specificity and particularity about numerous incidents, including strangulation, forced sexual control, violence towards the children, and the September 2021 incident over business records. Her account was corroborated by the 2 oldest children and the housekeeper, and supported by the interventor's admission in criminal case and findings by police and the child services investigation. And then the opinion delivers the pivotal line. The court finds the abuse significant enough to negate its earlier finding that she had reason to know. It says that considering her circumstances, when the joint returns were filed, it didn't believe she could have questioned the accuracy without risking her or her children's safety. That is the story's core. The court is saying in plain terms that the "why didn't you ask more question" critique collapses when asking questions is portrayed as dangerous. Financial control reinforces it. The opinion says she didn't participate in preparing the return. The other spouse retained an accountant and presented the return for her signature. The court says he didn't give her reasonable opportunity to review it and demanded her signature. And even if she had time, the court says his restriction of access to accounts would have prevented her from confirming accuracy. It highlights that she made a reasonable effort by requesting the Merrill Lynch password and was met with demands of obedience and trust. Once knowledge is treated as negated by abuse and control, the rest of the factors don't need to be dramatic to support relief, and many are neutral. Marital status is neutral because Massachusetts doesn't recognize legal separation as a status and the divorce was pending. Economic hardship is neutral because she conceded she wouldn't suffer it. Legal obligation is neutral because there was no divorce decree assigning tax debts yet. Significant benefit is neutral because the funds were used to pay down debt for the medical center's real estate and equipment. She shared enjoyment of the benefit up to the divorce filing. He controlled the finances, and there was no evidence of a lavish lifestyle. Compliance after is neutral because the record didn't show compliance or non-compliance, but health weighs in favor. The record establishes years of abuse. She testified to feeling stressed and depressed, and the interventor considered her health was negatively affected during the divorce proceedings. Put it together, and the court concludes it would be inequitable to hold her liable for the understatement for 2019. It grants full relief under Section 6015F with respect to the deficiency and the accuracy-related penalty. In other words, the added IRS hit about $121,000 of tax plus $24,000 of penalty. It doesn't stick to her. And here's the punchline that is still stays faithful to the opinion's logic. The intervenor's big theme was basically she should have known, while the court's theme was she tried and the environment made real inquiry unsafe. The opinion treats trust and believe your husband not as a romantic slogan, but as a control mechanism paired with restricted access, intimidation, and documented violence. If there is a lesson here, it's that the tax court can be very technical until the facts demand it be very human. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this video and found this information useful, please give us thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.